Preparing for a financial analyst at Ameren interview? You've reached Candy Mentor, and this video is for you. We'll walk through 25 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Why do you want to work as a financial analyst at Ameren? I am attracted to Ameren because its financial decisions affect essential infrastructure, customers, and regional economic growth. The analyst role combines forecasting, variance analysis, capital planning, and communication with operational teams. I would enjoy translating financial data into practical recommendations, whether evaluating grid investment, monitoring operating costs, or assessing regulatory outcomes. Ameren's long-term perspective also appeals to me because disciplined analysis matters when projects require substantial capital and benefits unfold over many years. While answering, connect your analytical skills to Ameren's regulated utility operations, infrastructure investment, customer service mission, energy transition, and the opportunity to support decisions with long-term financial consequences. Question 2. What do you know about Ameren's business model? Ameren operates regulated electric and natural gas utilities, primarily serving customers in Missouri and Illinois. Its earnings depend on providing reliable service while recovering prudently incurred operating and capital costs through approved rates. The business is capital-intensive, so grid modernization, generation, transmission, and distribution investments are financially important. I would also monitor customer demand, weather, fuel costs, interest rates, and regulatory decisions because each can influence revenue, cash flow, and returns. Make sure to cover Ameren's electric and natural gas utility operations, regulated revenues, rate cases, infrastructure ownership, customer demand, operating costs, and the importance of reliability and regulatory relationships. Question 3. How would you build a monthly financial forecast for a utility business? I would begin with historical actuals and identify the operational drivers behind each major revenue and expense line. Revenue could reflect customer counts, usage, weather, and approved rates, while expenses might include fuel, purchased power, labor, maintenance, and depreciation. I would separately forecast capital spending, financing costs, and regulatory items. After building a base case, I would add sensitivities for weather, demand, commodity prices, and project timing, then reconcile results monthly and explain variances. In your answer, talk about historical trends, operational drivers, rate assumptions, weather, customer growth, fuel costs, labor, capital spending, regulatory adjustments, scenario analysis, and reconciliation to actual results. Question 4. What is the difference between a budget, forecast, and long-range plan? A budget is the formally approved financial target for a defined period, often used to measure accountability. A forecast is the best current estimate of what will actually happen, incorporating new information during the year. A long-range plan extends several years and connects strategic priorities, capital investments, financing, and expected returns. At Ameren, I would use the budget to identify variances, the forecast to support corrective action, and the long-range plan to evaluate infrastructure and regulatory strategy. Be sure to mention the budget as an approved operating target, the forecast as an updated expectation, the long-range plan as a strategic outlook, and how analysts use each for accountability and decision-making. Question 5. How would you analyze a variance between actual and budgeted operating expenses? I would first quantify the variance and compare it with materiality thresholds. Then I would decompose it into volume, price, timing, productivity, accounting classification, and one-time effects. For example, higher maintenance expense could reflect storm restoration, accelerated work, or an unfavorable vendor rate. I would validate the explanation with the responsible manager and supporting data, determine whether the variance changes the full-year forecast, and present both the root cause and recommended action clearly. Focus on quantifying the variance, separating price, volume, timing, and one-time effects, validating source data, consulting business owners, assessing forecast implications, and communicating a concise root cause explanation. Question 6. Explain the relationship between capital expenditures, depreciation, and cash flow. Capital expenditures use cash when assets are purchased or constructed, but the cost is generally recorded on the balance sheet and depreciated over the asset's useful life. Depreciation reduces accounting earnings without a current cash outflow, while the original capital spending reduces cash flow immediately. For a regulated utility, qualifying investment may enter rate base and support future cost recovery and allowed returns. Therefore, I would analyze both near-term liquidity and the asset's long-term economic contribution. Make sure to distinguish capital spending from expense recognition, explain depreciation's non-cash nature, describe timing differences, and connect utility capital investment to rate base, financing needs, and future earnings. Question 7. What is rate base, and why is it important to Ameren? Rate base is the amount of qualifying utility investment on which a regulator permits the utility to earn an authorized return, subject to jurisdictional rules. It generally includes useful plant and related investments, adjusted for items such as accumulated depreciation and certain working capital components. Rate base matters because Ameren's infrastructure program can support future revenue and earnings when investments are prudently incurred and approved. As an analyst, I would track additions, retirements, depreciation, and regulatory timing carefully. In your answer, define rate base as the regulated asset investment eligible for recovery, explain the allowed return and depreciation, and connect it to capital planning, earnings, customer rates, and regulatory approval. Question 8. How do rate cases affect a utility's financial performance? A rate case determines how much revenue the utility may collect from customers to recover prudent costs and earn an authorized return. The outcome depends on the regulator's review of the test year, operating expenses, capital investment, depreciation, financing costs, and customer impacts. A favorable decision can improve earnings visibility and cash recovery, while delays or disallowances can create regulatory lag. I would model requested and approved outcomes separately and clearly identify timing and execution risks. Discuss the regulatory process, test year revenues and expenses, requested versus approved rates, allowed return, timing lag, prudence review, customer affordability, and the effects on earnings, cash flow, and investment recovery. Question 9. How would weather affect Ameren's financial results? Weather can materially influence utility demand, especially through heating and cooling usage. I would compare actual heating and cooling degree days with normal conditions, estimate the resulting volume impact by customer class, and distinguish weather-driven revenue from underlying usage trends. Severe weather can also increase restoration, labor, and materials costs. My analysis would show reported results, weather-normalized results, and any regulatory recovery mechanisms so management can understand both performance and sustainability. Be sure to mention heating and cooling degree days, electricity and gas demand, revenue sensitivity, normalization methods, storm costs, geographic differences, and the importance of separating weather effects from underlying customer trends. Question 10. What financial metrics would you monitor for Ameren? I would monitor operating revenue, earnings, operating expenses, operating cash flow, capital expenditures, rate base growth, and free cash flow. Because Ameren is capital intensive, leverage, interest coverage, debt maturities, and financing costs are also important. I would pair financial measures with operational indicators such as customer growth, demand, reliability, outage performance, and regulatory recovery. Looking at trends, forecast variance, and peer context is more informative than relying on any single metric. Focus on revenue and earnings growth, operating costs, cash flow, capital expenditures, rate base growth, regulatory recovery, leverage, interest coverage, return measures, reliability, and customer-focused operating indicators. Question 11. How would you evaluate a proposed grid modernization project? I would evaluate the project through both financial and operational lenses. Financially, I would model construction spending, depreciation, financing costs, operating savings, potential rate recovery, taxes, and cash flow timing. I would calculate NPV and returns under multiple scenarios, including delays and cost overruns. Operationally, I would consider reliability, safety, resilience, customer benefits, and regulatory alignment. The recommendation should explain not only whether value is created, but also who bears the risk and when benefits appear. In your answer, cover project costs, construction timing, operating benefits, reliability, regulatory eligibility, rate-based treatment, NPV, risk scenarios, customer impact, and alignment with Ameren's strategic priorities. Question 12. Walk me through a discounted cash flow analysis for a utility investment. I would project incremental after-tax cash flows from construction through the asset's useful life, including capital spending, operating benefits, maintenance, taxes, and any expected regulatory recovery. I would discount those cash flows using a rate appropriate for the project's risk and capital structure. If a terminal value is relevant, I would calculate it conservatively and test key assumptions. Finally, I would compare NPV with the required investment and stress test timing, cost, demand, and regulatory outcomes. Make sure to explain forecast cash flows, terminal value, discount rate, taxes, capital spending, working capital, regulatory recovery, sensitivity analysis, and the difference between project value and accounting earnings. Question 13. How do rising interest rates affect Ameren? Higher interest rates can increase borrowing costs, reduce project NPVs, pressure customer affordability, and make refinancing more expensive. They may also affect valuation through a higher discount rate. For a regulated utility, the eventual rate case treatment of financing costs and the authorized capital structure are important offsets, but recovery can involve timing lags. I would analyze debt maturities, fixed versus floating exposure, interest coverage, forecasted capital spending, and alternative financing scenarios before drawing conclusions. Discuss higher debt service costs, refinancing risk, discount rates, project economics, customer affordability, allowed returns, credit metrics, and how analysts should model both immediate and longer-term effects. Question 14. What is free cash flow, and how would you interpret it for Ameren? Free cash flow is commonly operating cash flow minus capital expenditures. For Ameren, it may be pressured by major grid, generation, transmission, or renewable investments even when the business is financially healthy. I would therefore distinguish maintenance capital from growth or regulatory-driven investment and examine the expected recovery and returns. I would also review debt issuance, liquidity, dividends, and project timing. Negative free cash flow is not automatically concerning if investment is disciplined and financeable. Be sure to define operating cash flow less capital expenditures, distinguish growth investment from maintenance spending, discuss financing needs, regulatory recovery, dividends, and why negative free cash flow may be temporary. Question 15. How would you assess whether Ameren's capital program is financially sustainable? I would compare planned capital spending with operating cash flow, rate-based growth, expected recovery, financing capacity, and credit objectives. Then I would assess whether projects are prioritized by reliability, compliance, customer value, and risk-adjusted returns. I would stress test cost overruns, construction delays, lower demand, higher rates, and regulatory disallowances. Sustainability means the program can be funded while preserving liquidity, acceptable leverage, credit quality, and a credible path to customer recovery. Focus on project prioritization, cash generation, rate-based growth, funding sources, leverage, credit ratings, regulatory recovery, construction risk, dividend commitments, and sensitivity to interest rates and delays. Question 16. How would you analyze fuel and purchased power cost variance? I would decompose the variance into market price, usage volume, generation mix, weather, plant availability, hedging results, and timing. I would compare actual fuel and purchased power costs with budget assumptions and determine whether the difference is recoverable through a fuel or purchased power mechanism. I would also evaluate cash flow timing and customer rate implications. The final explanation should distinguish temporary commodity volatility from structural changes in demand, dispatch, or procurement strategy. In your answer, separate price, volume, generation mix, weather, hedging, market exposure, recovery mechanisms, timing, and accounting effects, while explaining the impact on customers and earnings. Question 17. What is the difference between generally accepted accounting principles earnings and adjusted earnings? Generally accepted accounting principles earnings follow standardized accounting rules and provide the primary basis for financial reporting. Adjusted earnings typically exclude items management considers unusual, non-recurring, or not representative of ongoing operations, such as certain regulatory or impairment impacts. I would always reconcile adjusted results to generally accepted accounting principles and ask whether exclusions are genuinely unusual or recurring in substance. For Ameren, adjusted metrics can improve operating trend analysis, but they should supplement rather than replace reported earnings and cash flow analysis. Make sure to explain generally accepted accounting principles as the standardized accounting measure, adjusted earnings as management-defined exclusions, the need for reconciliation, recurring versus unusual items, and the risk of overlooking real economic costs. Question 18. How would you ensure accuracy in a complex Excel model? I build models with separate input, calculation, and output sections, clearly label assumptions, and avoid hardcoding inside formulas. I use checks for balance sheet integrity, cash flow reconciliation, sign conventions, totals, and unexpected changes. I reconcile outputs to source reports, test sensitivities, and review formulas independently, especially around dates and linked schedules. I also maintain version control and document material assumptions so another analyst can understand, challenge, and reproduce the model. Discuss clear structure, source data controls, documented assumptions, formula consistency, checks, reconciliations, version control, sensitivity testing, peer review, and independent validation of key outputs. Question 19. Tell me about a time you found an error in financial data. In a prior analysis, a monthly expense trend appeared unusually favorable compared with operational activity. I traced the variance from the summary report into the transaction detail and found that several invoices had been posted to the wrong period. I confirmed the issue with accounting, corrected the schedule, and updated the forecast. I also added a period cutoff check and documented the review step. The experience reinforced that analytical skepticism and reconciliations are essential, even when results look positive. Be sure to describe the initial warning sign, investigation process, root cause, correction, communication, control improvement, and measurable impact without blaming colleagues. Question 20. Describe a time you had to explain financial information to a non-finance audience. I once explained a department's unfavorable cost variance to an operational manager who did not work with financial reports. Instead of leading with accounting terminology, I connected the variance to overtime hours, contractor rates, and delayed maintenance work. I used a simple bridge from budget to actual, highlighted what the manager could control, and confirmed the underlying facts together. That approach created a practical action plan and showed me that clarity is more valuable than technical complexity. Focus on simplifying the message, using operational language, tailoring detail to the audience, explaining business drivers, confirming understanding, and ending with a clear decision or action. Question 21. How would you prioritize competing requests from senior stakeholders? I would clarify the decision each request supports, its deadline, materiality, and consequences of delay. I would prioritize regulatory, customer, safety, and executive commitments appropriately while considering dependencies and available data. I would communicate my proposed sequence and expected delivery times rather than silently juggling everything. If two priorities remained incompatible, I would escalate with clear trade-offs. This ensures stakeholders understand both what will be delivered and why that order best serves the business. In your answer, mention urgency, decision deadlines, financial materiality, customer or regulatory impact, dependencies, effort required, transparent communication, and escalation when priorities genuinely conflict. Question 22. How would you analyze a project that is over budget and behind schedule? I would first establish the approved baseline, incurred costs, committed costs, remaining work, and revised completion date. Then I would identify whether overruns result from labor, materials, design changes, permitting, vendor performance, or scope growth. I would update the cost to complete and cash flow forecast, recalculate project economics, and assess regulatory recovery or potential disallowance. Finally, I would present mitigation options, decision points, and escalation needs rather than simply reporting that the project is unfavorable. Discuss cost to complete, schedule variance, root causes, committed versus incurred costs, contingency, revised NPV, regulatory treatment, stakeholder impacts, mitigation options, and escalation thresholds. Question 23. What risks do renewable and energy transition investments create for a utility analyst? Energy transition projects can create value but also introduce permitting, construction, technology, transmission, interconnection, policy, and market price risks. Intermittent generation may require storage or backup capacity, while tax incentives and regulatory treatment can materially affect economics. I would model production assumptions, schedule, capital costs, operating expenses, incentives, financing, and recovery under multiple scenarios. I would also evaluate customer affordability and reliability, because a financially attractive project still needs durable regulatory and operational support. Be sure to mention policy changes, permitting, construction costs, intermittency, transmission needs, tax incentives, technology risk, market prices, customer affordability, and regulatory recovery. Question 24. What questions would you ask before recommending an investment or cost-saving initiative? I would ask what problem the initiative solves, how benefits are measured, who owns execution, and what assumptions drive the business case. I would clarify upfront investment, recurring savings or revenue, timing, regulatory treatment, customer impact, and downside risks. I would compare alternatives and test sensitivity to cost, demand, rates, and delays. Before recommending approval, I would define milestones and post-implementation metrics so actual performance can be compared with the original case. Focus on strategic purpose, baseline assumptions, measurable benefits, implementation timing, risks, ownership, regulatory treatment, customer effects, financing, sensitivity analysis, and post-investment performance measurement. Question 25. What makes an excellent financial analyst at Ameren? An excellent analyst combines technical accuracy with business judgment. At Ameren, that means understanding how customer demand, regulation, capital investment, reliability, and financing connect to financial results. The analyst should build dependable models, question unusual data, meet deadlines, and communicate implications in language that operating leaders can use. I would also emphasize integrity and ownership. If assumptions change or an error appears, raise it quickly, explain the impact, and help the team make a better decision. In your answer, combine technical accuracy, commercial judgment, utility and regulatory understanding, communication, integrity, curiosity, ownership, collaboration, deadline discipline, and the ability to turn analysis into decisions. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.